Welcome back to another Market Radar podcast. Let's take a look at what next week has in store for us. Monday, we've got ISM, and Thursday, we've got jobless claims, and Friday, we've got the employment situation. Those are the three main events we'll be looking for. Don't forget, Friday, markets are closed except the bond market. The bond market will be open. So let's take a look at what equities did this week. We had a massive continuation of the rally, and a question that I've been seeing everywhere, especially from the perma bulls, the perma bears, they just don't realize why the market is up. They're confused, they're angry, they're upset because there's just no reason for the market to be rallying. They got the recession fears, inflation still an issue. There's just so much wrong going on right now. They cannot fathom equities going higher. So that's the question that I want to answer in this podcast. Gamma, you want to take us into why you think the market is rallying, why equities are rallying, and what is driving this kind of price action that we've seen this past week?
Yeah, sure. So let's go back just earlier this month with this whole SVB debacle around the 8th and the 9th, mid-month, right? The market was really down on the lows. Everyone was panicking. And the bears almost felt like going into that, right, with this whole banking collapse, it almost felt like they had the perfect storm lined up, right? The bank collapse, you're shorting basically the financial collapse of the later part of the 21st century, right? You had the first one being the 2008 financial crisis, and this was what they thought would be the GFC 2.0. Then you had the Fed come in, and they threw basically a whole wrench in their plan, and they were able to basically backstop the issue. Now we can argue that the whole move off the lows is not QE liquidity, whatever you want to be. It's an improving environment of liquidity. We can make that argument, 7 ways to Sunday. But what really happened was the reason why the market was down off the lows in the first place here Wednesday, the reason why we went down from Wednesday on March 7th, but between March 6th, and March 10th was banking collapse fear, the banking crisis. That was averted basically by the Fed's actions, backstop, almost making it impossible to see a mass regional banking failure, right? It was pretty much like they say, recession avoided. It was banking crisis avoided. Now, what ends up happening is going into that weekend and even after those following few days, you had people basically saying that the Fed was going to have to pivot. Recession's coming. We saw if we take a look at the 2s and 10s, this is basically a market recessionary index, right? We went from negative 100 basis points pretty much all the way up to negative 30 basis points in a matter of days. And this type of volatility blew up the bond move index. Everyone was screaming, "Oh, bond volatility, the highest it's been since it might be post. It was higher. It's the highest it's been since 2008, I believe. Right? That's what they were saying."
There's a lot of things going on that haven't happened since 2008, and that's just another reason why so many people are bearish and they can't believe that equities can move higher.
Exactly. So the move index did put its highest levels in since 2008, and everyone was basically screaming, why isn't the market crashing? And they thought they'd have the upper hand by pressing the shorts. Now, what happened was the complete opposite, right? The Fed basically backstopped the reason for the market to go down. And the market started picking up on this and moving higher. Growth at the time was rather well maintained. Since then, we've seen it adjust a bit, but going off this low, everything seemed good and dandy. And the market basically got caught. You basically had the market catch a bunch of simps offsides. You had them all positioned for a revisit of the lows, and worse. Like, you had them all thinking that you had the entire market, not just the simps. You had everyone questioning it. And if at the beginning, we didn't think this was going to be a systemic issue. Then as we saw a few more banks fall, even us, we were saying, okay, could this spread? Then Credit Suisse, right? Could this be an issue? And the question started to be raised. And then the Fed, and between Silicon Valley Bank and Credit Suisse, obviously we had the BTFP facility in place, so that kind of alleviated some fears. By the time Credit Suisse came around, it was more of okay, this might not be an issue, and surely enough, UBS takeover, not an issue at all. So the message that was really getting placed is there are no bank failures. Either the bank's going to get absorbed, bailed out, or basically restructured. So this whole banking crisis that drove markets from the March highs, the early March highs to the mid March lows, was pretty much negated rather quickly. And now you can argue that there's this new liquidity metric from the Fed. We know it's not QE. We've said since day one this is not QE. The Fed's not actually buying anything, but it is a liquidity injection in a way. How that seeps into the real economy, that's debatable, given that most banks would most likely use that to deleverage their books to a degree so they can still function. How they do that, what they do with that, we'll see in the coming months how that's operated. But you had this whole psychological move off the lows. Now we're here. We're above we pretty much spent, if we turn off DDAP, we can take a quick look here where we were today. So we spent a lot of time, pretty much since February 2nd, this whole time up until today, where we really closed above the February 2nd highs. So that was the highs for the last almost 2 months. And what happened is you had everyone max short from the lows, because that's people don't, as much as you'd like to believe people short highs in markets or tops, people sell short lows. That's what happens. And that's why in bear market rallies, you have people, they're so vicious because it's so much easier to lose faith in something than it is to gain the faith. So when things are down and out and everyone's feeling like shit, it's easier to say, you know what, more pain. I don't want to deal with this, or I don't want to deal with any more pain. Get me out, or the shorts, they get greedy. And you have this there's always going to be a desire to own something that is working against you. So that's why these bear market rallies are so vicious, right? Because you have everyone depositioned into a move where FOMO is just so powerful. And what ends up happening is you have this whole move off the lows where everyone's wondering what's going on. And as we go higher and higher, you'll notice that every attempt to push lower was rejected. And NASDAQ has been bullish. NQ futures have been bullish since March 21st. And obviously since then, things have pretty much stabilized. And we haven't really seen price action below the March 21st days range, except for 1 day quickly here. And then now we're ripping. So,
yeah. Well, the Russell, the NASDAQ doesn't have that financial exposure, so it didn't really get affected too much from the whole banking issue. But looking at the Russell, it's still lagging behind quite a bit. And then also the 10s and 2s, the yield curve, still remain elevated. What is that telling you? Is that because that's telling me that these issues aren't quite gone yet?
No,
if they were gone, the twos and tens here would be back at the lows, wouldn't they?
Yes, but there's also the 2s and 10s are going to have to accurately reflect the fact that the Fed hiking cycle seems to be over, right? Not the pause cycle, because there's still a high probability, and we're starting to see that rebound, as we said it would, that the Fed is going to hold rates rather than do anything. Maybe 1 or 2 more rate hikes, one most likely in May, and then they're going to just hold rates until at least the end of the year, unless something dramatic happens, which would have to be beyond the scope of what we've seen already. We've said that, and slow and steady, we're starting to see those probabilities rebound. But in terms, like, the 2s and 10s shouldn't go back down here, because the Fed doesn't have to be as aggressive. This was when the 2s and 10s made this negative 100 basis point low. It was when we were looking at a possible 50 basis point hike and almost 600 basis point terminal. And what ended up happening was the short end, the twos, were getting ripped higher. And if we can look at them right here, right? The twos were getting ripped higher all the way to 5%. And the tens obviously aren't going to get ripped like that because the Fed policy in general is being priced in as shorter term. It's not going to last 5 years, right? So or anything that would be large enough to implicate such a great effect on the longer end maturities. So what ended up happening was when we saw the twos accelerate like this, we really inverted the yield. These are really we really inverted the yield curve, the yield spreads, the twos and tens, and to get something like that again, we'd have to see pretty much of the Fed pricing in a 6% terminal without like in a short period of time, which I don't think we're going to see that, at least not right now. So we are off the highs though. That's important. And we said that this bullish trend, the way that the yield curve reversions happen are in 2 stages. Step 1, bullish trend. You're not going to get through Momo and go above zero and revert without being bullish trend, given that Momo is all the way at negative 58 basis points. So we are bullish now. The question is, do we hold bullish? And we're seeing the spread today hold Momo as of Friday. It held. So the question now is, do we hold here, revert higher? And as this reverts higher, what it's doing is it's fueling the recession theme, the idea that we're going to get a recession, because as this goes up, it means the difference between the twos and tens or the tens and twos, tens minus twos is dropping. And that's primarily due to the twos of the equation becoming smaller than the tens, pushing the yield curve towards or reducing in yield against the tens, pushing the yield towards zero. Because the reason that this is inverted right now, negative, is because the twos have a greater value than the tens, meaning the twos are paying more. The yield on the twos is higher than it is on the tens. So let's just say the yield, hypothetically, yield on 10 years 1, and now the twos are higher, so we'll call that 2, right? 1 minus 2 is negative 1. So the reason this is negative is because the twos are paying more in yield than the tens.
Yeah. Now, well, as so the Fed, what else is telling us that a recession is on the horizon? Like, are there any other indicators to look at? Now? So as we're getting this equity rally, like, could this possibly be that equity rally that we've been talking about the past few months that makes everyone think, okay, we got the soft landing, but behind this, like under the surface, we have a recession actually starting to brew, and the hard landing starting to build up underneath while nobody's noticing.
Right. So that's a good direction to take the conversation, and primarily, let's start the focus on what an actual hard landing looks like. And a hard landing is basically the idea that the Fed has to cut aggressively because unemployment starts exploding, and inflation starts decelerate, or we get a rapid sign of deflation. Now, it seems like the soft landing, even though it's impossible, it's seeming like more and more that the soft landing is going to be perceived as possible. And what I mean by that is there is going to be a considerable lag between the pickup of unemployment and the drop in inflation. And we've seen this happen historically. If you look at the differentials between inflation and unemployment, there are periods in history where inflation actually does fall off and unemployment lags and then accelerates thereafter, making it seem like a soft landing has occurred. But in reality, if you widen your horizons and just widen the scopes and take the blinders off, you'll realize that the soft landing has never actually occurred. And it will likely never occur because the Fed has to restrict the economy enough to kill inflation. By doing so, they kill a lot of other things like growth, the unemployment market, and anything else that's in there that would be a part of growth, like production and all these other things, demand, and that all falls under growth. But that's going to happen most likely from the way the Fed policy has gone and where it seems to be going. And there's definitely seems like there's going to be a lag because the rate at which the Fed moved policy at such a rapid, or remember, we're talking almost 500 basis points in like 14 months. Or 17 months. That's extremely rapid by the next meeting. Yeah. And that by the time that plays out, you'd have to assume that we will see some changes in the unemployment market. Now, that how that plays out to the T is not really that imperative. What's imperative is following the regime scape going forward, right? So, can we see an environment where both bonds and equities go up? And yet, and that's the question that you should be asking. Not are we in a new bull market? Like that's not what you need to be asking. What you need to be wondering, or what you should be questioning, is can we catch ourselves in an environment similar to 2019, where 2018, 2019, where the regime scape was deflation. Bonds performed really well. And then we got they rolled right into COVID too. So it was like basically two birds, one stone there. But in terms just from 2018 to 2019, equities did well too. So the question is going to be, can we see something like that happen again? And I have a feeling like we can. And I think that my reasoning behind it is not very complicated. And that the fact that equities may not perform is a possibility, but it's not something that's going to really hinder our process and basically the system, because we're going to be we're never long bonds or equities at the same time. Either it's bonds or bonds and gold, excuse me, or just equities. It's never going to be bonds, gold, or bonds and equities and gold, or equities and bonds. They're never mixed. So it's either bonds and gold, or equities. So if one of them don't work out and the system's pointed in the right direction on the other one, it's fine. It's no big deal. But the reasoning why we could see the rebound in equities is if inflation is over, or we think it's over, and inflation's on the downswing over the next 6 to 8 months, this whole fear of this runaway inflation that the market has been aggressively pricing into the downside is now over. And, we can take a look at, you want to take a look at a basket of shit companies. It's easy. You just type in ARK. Okay. These are the basket of the shittiest companies you can find.
Yeah.
And this thing, let's turn off DDAP. This thing off the peak is down still 74%. Okay. So when the bears say, we need a bear market, we haven't seen the real crash yet. I'm going to counter that with, if this is not the crash, then God fucking speed. Because I don't know what the crash would look like when you have Amazon. Take Amazon, for example, and we'll go from the peak to bottom. It drew down 56%. You're talking about at the time, a $2 trillion company. Draw down $1 trillion in market cap. It's wild. Now, could this go lower? Yeah, if equities fail, if the NASDAQ really just goes back to bearish trend, definitely they could go lower. But you have to look at it from the other side, right? You have to look at it from both sides of the coin, where a lot of destruction was basically endured rapidly by markets. We're talking, the fastest rate hiking cycle in decades, if ever, right? Given where we'll see where rates end up. But the market even though inflation is a lagging indicator. The market's pricing in things real time. And the Fed is also a lagging indicator, because the market moved on anticipation of where the Fed rates would be in the next few meetings. So just because the Fed is now only getting to 500 basis points, that's old news to the market. The market at one point, just a few weeks, just a month ago, thought we were going to be at almost 600 basis points. That was pricing that inactively. As it was happening. So now rates are seen to be lower. It means policy could be less restrictive, and it could also mean that the market itself has over discounted the ability of a very long, drawn out stagflationary environment. Meaning, a quicker reversion of inflation towards zero is going to be bullish, because it means the Fed has to be restrictive for less time than it would if inflation were to really remain sticky. We'd be looking at a completely different market right now if inflation was staying in the high single digits, almost double digits, right, 9s and 10s, and the Fed was at 500 basis points and it did nothing. This market would not be where it is right now. The reason the market is where it is right now is because it's forward looking. It's pricing in things actively. It's saying, okay, inflation's on the downtrend, which we know. We've been saying that for a while. The market's been obviously picking that up for months now. We can go back. The market hasn't really made new lows since October on futures on NQ, and it's been picking up on the idea that inflation's done. The Fed won't have to be that restrictive, and in turn, could the market take back some of this destruction? Yes, but typically when you see bonds and equities move in the same direction, which is known as it's almost always seen as the expansionary regime via the system. And when that happens, there's always going to be a better play. Meaning, if bonds and equities are both moving, one of them, if it's risk on, is going to be favorable against the other. And that being equities, is going to be they're going to outperform because you have that positive growth component. Which, when equities get that positive growth component, there's nothing that can keep up with them because everyone's chasing that growth. And on the other hand, what you have is on the other side, you have this deflationary event, but it's almost a contained deflationary event because it's almost like the market did the selling before the market had the market priced the recession in before the recession happened because everything was moving so quick. Now the question is, does growth really get so destroyed from here that the market has to fall apart to new lows and basically price in just more negative content than it, or negative context than it had to earlier in the year or earlier this year and later last year? And the question to that is still to be the answer to that question is still to be seen. But in terms of where the market can go, we have to keep it simple. The market is still the NQ is bullish trend. It can go higher. It's fine. There's no problem with NQ going higher. It's good for some. Listen, most people along the markets, they're perma bulls. Most people. You can take Twitter out of the equation. Take all that nonsense, all that noise out of the sphere. Most people have retirement accounts. They're just invested in the market. They're long-term people. They're like, okay, I own SPY or I own QQQ, just the long term. So this is good for most of the population because most of the population are buy and hold individuals. Really, the finance space and the macro space seems so large, but it's rather small in comparison to all the money that's out there. And in terms of what's going on, it's good for people to have you had people that were down 50% on NASDAQ finally getting lifted off the lows, and that's great. Now, in terms of where this goes and how this continues, that's going to depend on the underlying components within the system being growth and inflation. If inflation starts to rapidly start accelerating again, you can expect the Fed to have to start accelerating their path policy restrictions, and in turn, you're going to hinder growth, and in turn, you're going to send the markets lower. But everything in terms of where the Fed can go, the Fed is in a position now where there's more downside to their policy than there is upside.
Right, and that's the bull case for the bond trade.
And the equity trade, right? Like we were just saying, but the question is going to be how the growth gets affected and which one is going to be an outperformer over time. And the reason we look at bonds and gold or equities is that's the Aries positioning. And if for those that don't know, Aries is our risk on, risk off model. It will trade either bonds and gold or equities. Now, how it does that is based on the system outputs and market trend readings. So Aries will either go long equities or long bonds and gold. And the way that it's going to come to fruition is going to be the underlying condition of growth, because odds are we saw the peak of inflation and the market's slowly picking up on the on inflation decelerating. In terms of, I mean, we can take a look at commodities, right?
It also matters how much inflation decelerates, right?
Yes, that's true too.
If inflation does decelerate way too quick and way too much, that could also put us into deflation with no hope of equities rallying in that case.
Right. So that's a great point. It's the move and the degree of the move that will make the markets either accommodative or shocked in terms of equities. A light deflationary regime is not really bad for equities. It's not that it's almost like undecided.
If it's accompanied with some growth, at least. Right. If growth is completely in the shitter, then that's a different story. But then at that point, we'd probably be getting into Fed cutting rates territory, if growth
Right.
really is getting hit that hard.
And that's where you'll see the bond trade come to life. Like, yeah, what you can expect out of this is bonds. I think we've been saying this for months now. Bond downside risk has pretty much been negated. I think when did we come out with that? In like November-ish, we said that was pretty much over after we saw the peak in inflation. It was more of just chop risk, and that's exactly what we've been seeing this whole time. And we're waiting for bonds to flip the trend here, and really that'll start giving us some more some market direction in terms. We have the system direction right now. The market direction will be determined based on where bonds can go from here, and then we can get ourselves positioned up for the next leg in the cycle. But all in all, we have to remain rather vigilant here because it is a tough. It's not. I shouldn't say tough. It's a very tricky environment right now because a lot of people are being sold this facade that um, the new bull market is here. Now, while equities going up would be defined, yes, you can define it as a bull market. The key that which is what makes Aries so well is which is what makes Aries so good is what it can do so well, which is allocating capital to where the outperformances will likely be in the future. Meaning, if equities rally from here, we'll use the lows. I don't like using year to dates. I figure it's all skewed because it's just because the date happened on this day. It's up this much. It's a bunch of nonsense, right? But off the lows, we're up pretty much 22%. Let's just say equities can go up another 10% from here, right? 30% off the lows, whatever. And they can continue this grind. Obviously, the rate of this move has been rather rapid. And Twitter will say it's the collar bros, but like they're fucking clueless too, so that doesn't really matter. The rate will slow as we go along here and as volatility becomes more and more compressed if we are seeing a continuation of bullish trend. The question is there more upside here or on long bonds? Because remember, long bonds can go up in two environments: deflation and stagflation. Now, stagflation would be very interesting to see because we had this whole period of stagflation last year where bonds were trading pretty much like shit, and that kept us out of the bond trade. So last year was such a long year for the radar crew because bonds were pretty much bearish trend all of 2022. And in stagflation, bonds are favorable, bonds and gold. But bonds kept us out of the trade because there was no we had a positive stock bond correlation due to the whole Fed rate hiking cycle, this absorbent amount of inflation, and the bond market wasn't liking it. It told us to stay out via the bearish trends, and we didn't actually long it. But typically, stagflation is a great precursor into deflation. But it seems we could be running into this issue, like we said, where growth may not dive down enough and we can get that expansionary push. But that is to be determined. As of right now, we're going to have to figure out where the next trade is going to be. And the debate right now is bonds and gold or equities. And equities are holding up rather well. But the question is the upside of each of them and where our Aries is going to want to allocate capital to in the following months. So that's what we're going to keep an eye out for and stay keen because things can happen rather quickly, and you don't want to be caught in dead capital because that's the worst, especially with leverage. That's where you get chopped and eaten alive. Specifically in the leveraged ETFs, when things aren't moving and you're just eating that volatility drag, and that's just a shitty experience. But I think we can wrap the podcast up there. Actually, before we go, I just want to leave off on the dollar. This is going to be a quick statement. The dollar is not debasing. Okay, yeah, BRICS could be a risk to it at some point. The dollar's not going anywhere anytime fast. We need to see pretty much think of the BRICS development times 10. It needs to tenfold for it to be serious. This is not going to crush the dollar detrimentally in any way in terms of where the dollar has been, meaning the dollar at 90 was where it was in 2020. It's possible we can go down there, and that wouldn't be considered the BRICS crush. The BRICS crush that these people are trying to sell, this whole dollar debasement theory, is basically saying the dollar is going to be at 50 points, going to be down 50%, like down to the 2008 low, lower than 2008. That's what they're trying to say. Could that happen? Yeah, if the trends line up. Right now, dollar has been bearish trend. Dollar has been bearish trend since November. We've been saying dollar has downside risk the whole time down. On this rally up, we said that the dollar again would have downside risk at some point, and we started screaming about the trade of lost souls up around the 28th of October of February, excuse me. Which all that is simplified: dollar up, a dollar down, euro up, equities up, and bonds chopped. So far, that's exactly what's been
Literally
happening.
exactly on point.
Yeah. And now when the saying the dollar having downside risk is not dollar debasement. There's a drastic difference between debasing the dollar and dollar just going down and devaluing gradually. So those people that are telling you the end of the dollar standard, or basically global dollar reserves being the primary holder by all the central banks, and that they're going to pivot to gold or some nonsense like that. There is not enough gold on this planet to do that. There is not enough Swiss francs on this planet to do that. And the BRICS currency, the BRICS group are trying to back their currency by something. If it's pegging to each other, I believe it's pegging to, the idea is to back it with gold. That again, from my understanding, it's to back it by gold, and that again is not going to be logistically possible. You need currency that is inflatable and backed by having a solid reputation as a government. You can argue all you want about the government's political antics and political stances, but at the end of the day, when it comes to business, when it comes to everything, like for example, Apple, Microsoft, Google, Netflix, basically all the biggest companies in the world, they're in the United States. So if you think they're going to move their headquarters to Nigeria or Russia, you can bet your bottom dollar they won't. And for now, the dollar remains the king. We will likely see the dollar progressively erode if it doesn't become the king, but it's not something that would happen overnight. It's not something that you need to be scared about. Other than that, we're going to wrap the podcast up here. Thank you guys so much for listening, and we'll see you in the next one.